New folks joining, welcome to Beanstalk University. If you have any questions, please drop them in the town hall chat or raise your hand. We're just gonna dive right in. JWW asks, Publius, can you explain like I'm five the difference between Beanstalk and Terra Luna?
So the there's a lot of differences, and we recorded an entire podcast on the Bean Pod to really get in depth on how the models are different. But the explain like I'm five version is that the primary backer of Terra or UST and the stability behind it was demand for Luna. And the concept is that Luna was protocol native collateral, and the only reason for holding Luna was speculative value on the future growth of the system. And in particular, there's lots of different issues that played out in practice, but the fact that the Luna token is fungible when the system needed a bid, when there was very clearly excess supply and people needed to price the Luna token, there was a run for the exits for both UST and Luna that was, it was facilitated for a lot of different reasons, but it was exacerbated by the fact that there was no real reason to buy Luna in the short term, and that led everyone to front run and sell their Luna, and that created a death spiral. So Beanstalk, instead of using protocol native collateral, doesn't use collateral whatsoever, and instead uses credit. So in theory, what that means is Beanstalk tries to borrow assets, in particular beans, from the market in order to remove beans from the supply anytime the price is too low. And in practice, whereas something like UST was designed to be stable within a range at all times or at most times, and everyone, or it seemed that most of the people that were using the protocol at the time had that expectation, Beanstalk welcomes volatility and recognizes that it cannot maintain the price of a bean at $1 really ever for any period of time, and instead merely tries to oscillate the bean price above and below the peg, where when the price is too high it can easily mint new beans, but when the price is too low, instead of backing it with protocol native collateral, Beanstalk tries to borrow beans. And so the credit-based model is fundamentally one of whether or not you think the protocol is credit worthy. And if we get into what we were commenting on about the Luna fungibility, a debt in Beanstalk is first in, first out. It's non-fungible. And so when the knife is dropping, there is an incentive to catch the knife at some price because you can get in line. And you have an expectation that there's a benefit to getting in line before other people, whereas if you have a fungible token, then the efficient behavior is to wait until the entire market clears and not to price it yourself effectively. Certainly not to be the first mover. So there's a lot of different reasons why Beanstalk is designed to be anti-fragile in these scenarios where it faces a bank run. It welcomes bank runs in the sense that it doesn't pretend like they're not going to happen, and instead it's just designed to minimize the extent of them as much as possible. Whereas it seems like in practice, Terra was unable to sustain or withstand any bank run really of any size.
Awesome. From Lange, how much OTC have been confirmed at the moment?
The confirmed would probably be in the same range of last week, around 20% of the total. And again, that's more because we don't want to, until things are signed and in the door, it's very hard to comment on it. And that's one of the things we've experienced over the past couple of days. There was some stuff that was signed, and then when people got burned out in Terra, they're like, we can't send you the money anymore. So there's probably $1 million that fell out as a result of that, or more, maybe a little over $1 million, and then there's been some more money that's come in to replenish it. So probably in a similar spot. But then additionally, there have been a couple different, I think at this point, vehicles and entities formed to potentially take in capital from different investors to participate, and we'll see whether any of them raise capital. But there's lots of formation happening now that the DAO has approved the terms and the next steps.
Awesome. Mod asks, can you take us through the logic of having a vesting period, and what does that mean to the barn raise and to post-barn raise participants?
Sure. So the vesting period serves a couple of purposes. The main one is that there won't be any beans minted upon relaunch, or that can be sold in theory. There's no supply unless there is demand for beans. And that's a core principle of Beanstalk from the beginning. Whereas if you reinstate Beanstalk to its prior state, where you have $200 million of liquid assets and 108 million liquid beans or so, there's potentially a significant amount of supply, and it's very hard for the market to price it. So the primary reason is that any vesting that happens to the reinstated assets will be in line with demand for beans. Now, the other main reason is to align the people that are lending to the protocol at this point in time with the capital that was liquid prior to the attack, such that the lenders don't have a concern that the people that they're lending to will be sold into immediately, or they won't be providing exit liquidity, if you will. So those are the two main benefits or reasons for a vesting structure. And in particular, the vesting structure that the barn raise has.
Great. From Kobe Bean. Any take on the is Beanstalk a stablecoin question that's been discussed recently?
That is a semantic question, which, it's funny. We've always pushed back on the concept of like the term algo stablecoin, like an algorithmic stablecoin. I think that's where people get particularly confused. Every stablecoin is an algorithmic stablecoin, even USDC. Now, DAI is probably more of an algorithmic stablecoin than USDC is, but there's an algorithm for every stablecoin. So the concept of algorithmic, that's a non-proper description. Now, a stablecoin issuer, a stablecoin protocol, or a stablecoin itself, I think it's a pretty good name. It's an asset that's designed to be pegged to something. Now, different types of stablecoins have fundamentally different things backing them, and we are big fans of the concept of a credit-based stablecoin, and think that's very transparent, that the backing of the stablecoin is credit. And it's like, what's credit? Well, it's the ability for Beanstalk to attract lenders. There's no collateral, and it's very important, and this is one of the benefits of having classes like this, for everyone to be on the same page about how Beanstalk works and what it means, and what it means to be a credit-based stablecoin, And there's a lot of uncertainty about what is actually possible at this point. People are skeptical as to whether you can ever issue a non-collateralized stablecoin, and in particularly a non-exogenously collateralized stablecoin. We would push back against that notion heavily for a variety of different reasons. But the concept is Beanstalk is certainly issuing an ERC20 that's designed to be stable over periods of time. It's not meant to be stable at all periods of time, whereas other stablecoins are, but don't necessarily think that means that beans are not a stablecoin.
Awesome. Question from Dumpling. How will the mechanism work for a user to harvest the bean mints from the Barn Raise NFTs? Just a button on the website like the idols have, perhaps? Do you anticipate any difference in user behavior due to the smooth rewards instead of the choppy returns of different plots harvesting?
So, two good questions. In terms of the UX, assume it will be similar to a harvest, or almost identical, likely. In terms of anticipation of change in user behavior because of the smooth nature of the payments, if anything, there's something to be said for the likelihood of sell pressure from the distribution of these, because it's across a fungible token, are more likely to be random, as opposed to when you have pods harvesting on a first in first out basis. There's less of a random distribution on when the sell pressure happens. People tend to wait till the end of their plots, or at least for smaller plots, so there is some benefit there. Now, the benefit is truly marginal. I'd have to think really hard about what the actual benefit to that was, but that would be maybe the only difference, and you'd expect there to be some more smoothness in the sell pressure as a result of that, but that would be more in theory. We'll have to see how it works in practice.
Okay, question from Breezy. How does the timing or position in line in the redemption pile affect the return of the NFT when burned?
I assume the question is about the loan itself. So how does the timing of the loan... I'm sorry, I really don't understand the question, because there is no position in line in this case, so all of the NFTs are effectively fungible from an economics perspective, so there is no place in line. And in terms of timing, under the terms that the DAO approve, there won't be any preference in timing other than probably some sort of rarity boost on the NFTs or something fun like that.
Cool, Breezy. If you just want to clarify that question in Town Hall chat, we can continue there. I'll move on to Bean Esquire for now. So Bean Esquire asks, if and when Ethereum finally moves to proof of stake, if the Ethereum miners decide to fork the protocol as proof of work, would we automatically move to the proof of stake chain? Is that something we should address ahead of time? Any other risks to us if there's a fork?
A great question. A really fascinating thing to think through, and haven't given it too much thought. Now, the main point is the source of the liquidity that beans trade against, whether they can be forked. And in particular, if beans are trading against exclusively Ethereum, and you have something like ETH Classic distributed that then has value, in theory, there's no reason that the Beanstalk on both chains wouldn't function. Now, and in particular, not even necessarily depeg, assuming both the new ETH and the old ETH had the same value. Now, there is some risk that if there's a fork, the value between the new ETH and the old ETH is split, and there's some risk associated with that, certainly. But the bigger point is that beans trade against, or prior to the attack at least, and are likely to after it's restarted, trade against collateralized stablecoins like USDC and USDT and DAI, which is primarily backed by USDC. And so in all likelihood, all of those stablecoins will have to choose a chain. And in the world where there's a significant amount of liquidity trading against those assets, in the instance of an Ethereum fork, there will be some loss of economic value on one of the two chains if those assets are no longer valuable on that chain. So lots of different interesting things to think through in that case. It's likely that if there's, let's call it an ugly fork, where now there is a lot of uncertainty in distribution, we'll have to, I think this warrants a lot more discussion, frankly. The main benefit of trading against ETH exclusively in this case is then there's no loss of potential liquidity that you're trading against, because the ETH will just get forked, and now you'll have two different versions of Ethereum. Obviously, the dollar value of them may change, and also from an Oracle perspective, if USDC isn't on one of those chains, that could affect the ability for the Bean ETH, USDC ETH Oracle structure to work. So lots of different complexities associated with a potential fork, as you're describing.
Awesome. Asfi asks, is there any difference in the OTC deal versus buying the NFTs?
No, sir. Everyone is the same.
Awesome. And then their next question, actually, no, they just had trouble accessing. Okay, we'll move on to North. Once established on Ethereum, is there a chain or chains of choice where Beanstalk plans to deploy?
So the short answer is it's unclear. Beanstalk doesn't have any plans. It's a protocol, piece of software. Now, there are lots of people working on Beanstalk that have different thoughts about the best places to continue to build Beanstalk on, and one of the open questions is whether to prioritize ETH L2s or other L1s, and at this point, it probably seems like prioritizing ETH L2 development is a priority as opposed to L1 development, but there's no reason that both can't happen in tandem. But it's just a significant amount of development work. And the other thing to add is you look at something like what's happening on Solana, where the validators are conspiring to censor certain addresses. It's like, what is going on here? So, not in a rush to roll Beanstalk out on any chains that aren't necessarily super permissionless.
Right. Okay. Next question. Let's see. From Disco Stew. Speaking of ETH, how will ETH price moves affect the Bean ETH LP from the $77 million fundraise?
So the short answer is the goal of raising the $77 million distributed in US dollars is to restore the state of the protocol as it was prior to the attack denominated in USD. So therefore the ETH drop wouldn't affect the state of Beanstalk. Now in practice, the drop in ETH price may make it more difficult to raise funds, but that would be the only place that it actually has an effect, because the concept is whatever the LP pool, the pools are, whether it's Bean ETH, Bean 3 curve, to start, the goal is to have $77 million US dollars of value trading against the beans at the time, assuming a full recapitalization.
Okay. The Guilfoyle asks, if we could build up a reserve of credit from those willing to lend to Beanstalk, do you think that could help make Bean even more anti-fragile? Or are you against reserves of any kind?
What is a reserve of credit?
They just amended the message to say the dynamics for soil could work similarly to the initial barn raise auction with an expiry date like the pod marketplace. Guilfoyle, feel free to clarify what you mean by reserve of credit here. I assume you're referring to people pricing pods in some way, like a bidding mechanism. Okay, Breezy clarified their question. Let me see if I can pull this back together for you, Publius.
So the short answer is because Breezy seems to be a little bit confused and thinks that you need to burn the NFTs or that there's some sort of vesting schedule on the NFT. The point is you just hold the NFT. The NFT itself will accrue the beans. There's no need to burn the NFT at any point. There's no vesting schedule on the NFT. The NFT is on the recapitalized assets.
Maybe kind of expanding on that, we could walk through just like walk through the vesting mechanism there briefly. Or how new bean mints are distributed to those NFTs.
So let's say Beanstalk increases the bean supply by 100,000 beans in a season. A third of new bean mints will go towards stockholders, a third will go to old pod holders, and a third will go to the NFT holders. Those NFT holders at any time as they receive bean mints can harvest their beans and sell them, deposit them in the silo, lend them to Beanstalk if they're soil. They're just normal beans at that point. The vesting happens on the recapitalized assets. So let's say you had 1,000 beans in the silo, and Beanstalk is fully recapitalized. You're back to 1,000 beans, but now they're vesting. In the case where the NFTs have had half of the total amount of beans that they will be paid off over time have been currently paid, so half have been paid back. The vesting beans that I have in the silo that are worth 1,000 vesting beans, I'm only entitled to 500 of them. It's the concept. I'm entitled to half. So in short, if I claim my beans and I want to sell them, then I'm only entitled to sell half of them, and I forfeit my rights to the other half. So the vesting happens on the recapitalized assets.
Great. We're gonna bring Guilfoyle up on stage here. If you'd like to clarify your question, I just invited you. Hey, thanks for joining. Can you hear us?
Yeah, right?
I can.
Okay, great. So I just tried to explain the question again in town hall chat. The idea was that we could let anyone bid on future soil like we were thinking of doing for initially for the barn raise, and then lock in those bids based on weather and with an expiry date, kind of like the pod marketplace system. And in effect, then we could build up a reserve of people who are willing to lend to Beanstalk in the future, which could it could just be another mechanic along with the others you've mentioned to negate the impact of a run on the bank or to make Beanstalk more antifragile.
So we're going to be very against any reserve of any kind. If you look at the BTC reserve that TFL had, the LFG had, excuse me, I don't remember which it was. It's very clear that that was a catalyst for the depletion of the confidence in the system. So whether it's a collateral reserve, whether it's a credit reserve, as you're calling it, the concept is if there's some demand that can at its surface be eroded immediately to cause a loss of faith in the market, that should probably be avoided at all costs.
Okay, I see both sides of it, and yeah, you could. It's not hard to imagine that if you have a small reserve of credit, let's what we're calling it, then it gets depleted very quickly, then people lose even more faith in any sort of.
But what's the benefit? What's the benefit, I would ask?
The benefit is that you're building up this reserve in a time when sentiment is very positive, and so you're not relying on creditors when sentiment is low. That's the benefit. So if price is over 1 and things are humming along, I'm willing to say, oh, I'll lend to Beanstalk at any point over the next 2 months for 200 or 300% weather, whatever it's at. Then P falls below 1, and we don't have to rely on. We have this reserve of people who were willing to lend before, and their confidence in the protocol is locked in effectively. But I take your point that anything people can point to aside from the price is another potential source of, I guess, negativity. I don't know.
Well, it's not just about pointing to the price, right? You can point to lots of different short-term issues to try to create fear. But the main point is a substantive change in the state of the system is what you want to avoid. And if you introduce a reserve of any kind, that presents the opportunity for a substantive change in the state of the system.
So I don't really. It's a reserve in some sense, but it's also people's. It's a sign of confidence that we're willing to.
That's the whole point. That's exactly. You don't want to have the sign of confidence be destroyable for a minimal price. Exactly, 100%.
Okay, thank you.
Thank you, Guilfoyle. Let's head back to Town Hall chat. Mod asks, can unvested token holders sell their tokens to others? Yeah.
The unvested tokens will likely be there'll be a vesting bean token probably, and a vesting LP token, and those will be ERC20 tokens. So yes. Don't know exactly what liquidity will be like there yet. Just thinking through it, but don't really know.
Right, but at a minimum, if they're tokens, people could theoretically trade them OTC or move them around however they see fit.
Correct.
Awesome. J-Dubs ask, are the 1/3 of minted beans issued to NFT holders immediately siloed, or do they need to be claimed and siloed?
Claimed and siloed. They're like pods in that sense.
Awesome. All right, I've reached the bottom. Feel free to raise your hand or drop a question in chat, and I'll send it Publius's way. Well, we're in a bit of a lull here. So Beanstalk Farms is launching something today that we're calling the Beanstalk Learning Center, where basically we've taken all of the past recordings for Beanstalk University, AMAs, podcasts, pretty much everything we've ever done on a mic, and have published them with timestamps and notes in a searchable format. I'll drop the link in the town hall chat for you all to check out. But if you think this call is good and useful, definitely check those out. There's an incredible amount of content and ideas and discussion in those in that database. So definitely take a look. Welcome. We've got a hand from Aspie. Can I invite you on stage?
Hello, guys. It's really good to hear you. It's really good to be back in class. I just one question that's been kind of on my mind. It is that we've seen obviously sentiment worsen in the last couple of days, particularly around algostables. So when you think about demand reduction or I guess there's surely been some, I would say, fear and demand reduction. Does that factor in any of the, I would say, the things that you're currently thinking about or the changes that you're thinking about? Just generally looking to hear how you're thinking about the the changing, I guess, the changing demand for soil without the beanstalk actually running, given what we're just seeing around us.
Perhaps it's naive, but basically spend no time worrying about exogenous demand other than at the moment while we're capital raising. So it's just, there have been significant periods of time where there's no demand for soil and Beanstalk is fine, so, or has come out fine from it. So just generally that's not a focus. Short-term demand is not a focus.
Yeah, that makes sense. That totally makes sense. I mean, I guess for me, the only thing that I've been kind of mulling over is that from the original system that started that we saw working, the only tweak is that there's a third player coming in, and now there's just a third of mints getting shared. It's that split that but yeah, I get your point. I think it's just something we'll just have to turn back on and see. Thank you for that.
That actually, on that point, I would push back, because the concept is that, let's assume the protocol is fully recapitalized, but it scales because of the haircut. If you were lending to Beanstalk prior to the attack, you were getting in the back of a 700 million pod line. With 100 million bean supply, 2 times 700 million is 1.4 billion, plus 100 million is 1.5 billion. So people were lending to Beanstalk at a 1.5 billion supply. Assuming a full recapitalization where Beanstalk issues another 462 million pods, or the equivalent of, as a fungible asset, or non-fungible, but economically fungible, that would push the lending price to Beanstalk at 2 billion. Don't really feel like that is a substantive change, and there's very clearly a significant amount of demand for stablecoins, good stablecoins. Now, people's lack of demand for bad stablecoins, we think is great. Now, furthermore, it's hard to quantify good versus bad stablecoins, but the market is ultimately what decides. Now, the bigger point is one of the big problems that clearly affected Terra was having a community that didn't understand the mechanism and was very easy come, easy go. If you told me the main difference is that the money that's easy come, easy go is now not interested in stablecoins, we would say that is fabulous. And the less easy come, easy go money that comes into the system, the better. So, not a problem in our minds whatsoever, and probably a net benefit. Now, what is the overall demand? We're going to guess it's significantly higher than the current implied valuation on the lending side of $2 billion upon restart, and that would obviously scale based on the haircut. So if it's 50% haircut, then it's actually $1 billion. If it's a 75% haircut, it's $500 million. So feel like that's not, at least in theory, we wouldn't expect that to be. Now, maybe the market has really dramatically changed, and the thought is the demand for stablecoins is a tenth of what it was before, but that seems to be that would appear to us to be a radical overreaction as a result.
No, I agree. I agree. Thank you for that. That's really helpful. It's like, I keep finding myself in a situation where obviously I really want to invest. I think I will, but it's like I've got the whole world telling me, dude, no, are you fucking crazy? It's all falling apart. So, but this is very helpful to hear from you. Thank you very much for answering.
Yeah, and on that point, the hesitance and the questioning and the real uncertainty, that's fucking healthy, Nothing is promised. Nothing is promised. And this is an experiment. That's the first line in the roadmap. This is a real experiment. And sometimes experiments go really wrong. So the hesitance is very healthy.
Appreciate it. Thank you so much.
Awesome. Thanks, Asfi. Feel free to raise your hand or drop a question in town hall chat. Still at the bottom of the chat there. So I'll throw out a question for you, Publius. We've spent a lot of the last month or so focused on figuring out how to unpause Beanstalk. And there's been a lot of discussions about the barn raise and other similar things. I'm curious what you're excited to see built in the Beanstalk ecosystem after we unpause. I know we on the Beanstalk Farms front released a roadmap with some ideas there for the remainder of 2022 and perhaps beyond. But yeah, curious what you're looking forward to.
Well, one of the things we've always been excited about is the potential for what you can build on top of on top of a positive carry stablecoin. The coolest of which, in our opinion, I jumped the gun there, is a zero fee DEX. So some of the cool things that Beanstalk has been able to do is attract liquidity without any exogenous incentives or any fees for providing that liquidity, purely with protocol native incentives. And the thought is that using those protocol native incentives that attract liquidity, Beanstalk could attract liquidity without needing to charge any trading fees whatsoever. And that can drive the trading fees on DEXs all the way to zero, at least for pools that are trading against beans. That's really cool. Root is something we remain incredibly excited about. The idea of a rate swap on top of the positive carry of beans where people can lock in a fixed yield and trade a variable yield. That is fascinating as well, and our hope is that lots of other cool stuff will be built on top of Beanstalk in the not too distant future.
Awesome. Thanks for that. From Turboy, any updates on the audits, or is no word is a good word? Also, can you comment on we'll start with that and I'll go to the second question.
Okay, so the first is the Trail of Bits audit. We spoke with them last week. We're good to go. That's supposed to start first week of June, that Monday, whatever day that is. I think it's the 6th or something, and it'll run for 3 weeks. The the Halborn audit is underway. On that front, no news is good news, we hope, as you were kind of saying. Now, we did have a great call with Halborn, with not the team that's auditing Beanstalk, but just a different team at Halborn. They've been working on this new product called Seraph, which is like this effectively protocol that they use that's on chain to act as a last gate before certain things are executed at the protocol level. So in theory, different things like an emergency commit of a BIP or the withdrawal of all of the assets, all of that would have to be approved by the Seraph contract, and there's a whole process involved there that at some point is probably worth having a larger discussion about with the DAO on whether it makes sense to implement. But we thought it was very compelling, and we're working with them now to figure out how exactly an implementation with Beanstalk would work, and seems pretty cool. So very, very exciting that Beanstalk is now on the minds of very high quality audit firms, and we hope that will put Beanstalk in a much safer position moving forward.
Awesome. And then the second question there, can you comment on what Bean's death spiral would be, and has any more thought been put towards avoiding that?
So the avoidance of, or what does the death spiral look like first? It's that there's no demand for lending to the protocol. And in particular, that there's no demand for lending to the protocol, and the only interest rate that it's able to attract lenders is so high that it's not able to attract the next lender. So if it has to pay 1,000,000% interest or weather, it's not going to be able to attract a lender after whenever someone lends for 1,000,000% weather. So at some point, if Beanstalk cannot attract lenders, then that's what the death spiral looks like. Now, has any more thought been put towards avoiding that? Given the past week's events, that's probably the only thing on our minds. It's like an amazing amount of data that's just front and center now that would be foolish to ignore. So lots of thought being put towards that. The main conclusion is that while there are certain bells and whistles that can be used to further improve the model, in general, we do feel like the main key is education, that users have to be comfortable with volatility. And it's very clear that if you have a large ecosystem with sophisticated derivatives on top of it, volatility is the nature of the beast. You can't have a dip to 97 cents be the death of the protocol. If that's the case, then then what are you doing, right? So while the hope is to have very low volatility over most of the periods of time, Beanstalk is a protocol that welcomes volatility, and one of the main thoughts is that education is first and foremost, in addition to a strong model, obviously.
Awesome. Warthog asks, will generalized convert be available when we restart? And I guess related to that, will there be a Uni V3 BEAN ETH LP pool available?
So no V3. Figuring out how to price those NFTs is still pretty hard. So no V3 functionality upon restart. The generalized convert should be generally live. However, it's likely that there's only one pool, but it should support convert, and the pipes for generalized convert, assuming there are other pools, are also laid. So generally the answer is yes. Generalized minting and convert should both be available.
Awesome. From J-Dubs, how is Root different from Anchor?
So lots of different things. The biggest one is that the UST that was in Anchor was totally subsidized and basically collecting dust. So people were being paid a subsidy to hold UST. And even though in theory Anchor is structured as a money market where people are borrowing assets from one another, there was actually no demand to borrow UST from the market effectively. And so all of that UST was being lent out and then just doing nothing. And the rate that people were being paid for lending out that UST was totally artificial and subsidized. So the fundamental difference is that Anchor had liabilities that were basically infinite. They're paying or promising a 20% interest rate in perpetuity on infinite assets. And where does that yield come from? Well, it's purely subsidized. Like the UST wasn't doing anything in the protocol. So whereas Root has a couple fundamental differences. The first is there's no outstanding obligation the protocol will ever take on that it doesn't already have covered. So the protocol is denominated in beans, and if someone wants to lock in a fixed rate, call it 10%, call it 20%, call it 30% over a period of time, in order for someone, or in this case it's the protocol, to take the other side of that fixed rate bet, the protocol will only accept the deposit at a fixed rate if it already has the beans in its reserve unencumbered to cover the loan. And so or cover the deposit, however you want to call it. So if there's an obligation that the protocol has, it will have met it at all times. And so from an economics perspective, there should never be a question as to the sustainability of the yield, because it's actually a rate swap. And the fixed rate is effectively guaranteed at the time, because the fixed rate will only be offered if the protocol has the beans locked in at the time. Now, the other thing is, as we highlighted, the UST and Anchor wasn't actually doing anything. The beans that are deposited in Root for a fixed APY will be in the silo, providing liquidity and doing lots of other stuff, providing economic value to the system. So it's not like it'll be sitting there collecting dust.
Awesome. Reminder again to raise your hand or drop questions in chat. I've run out of questions, so we've got about 12 minutes or so before the end of the hour. Maybe while we're waiting for some people to throw some questions in, Publius, how are you holding up?
Oh, we have nothing to complain about, sir.
That's good to hear.
Nice that we're getting through all the questions.
Definitely. We've got one from RG. I think this may have been answered earlier, RG, but he asks, are we still at 20% soft commitment?
Generally, yes.
Kobe Bean asks, any thoughts on changing the season length from an hour?
Well, lots of thoughts. A day is definitely probably too slow. A second is too fast. 10 seconds, I guess, every block, whatever you want to call it, is too fast. So there's always a sweet spot. Now, there'd probably have to be a lot more modeling done on the perfect season time. It's likely to change as the state of the system grows. So for now, an hour is probably good enough. But at some point, that may change. But for now, not necessary.
How would that change as the system grew?
Well, if the system was super efficient, you might want a faster season time, right? If the market was really being focused, there's no problem with a faster response time per se. But you don't want to be too fast. It is important that the market has time to settle during each season, but an hour might be too long for the market to settle in the case where there's high frequency trading and endless stuff happening on the system. Maybe you want every 10 minutes. I honestly, this is one of the most subjective things about the system, and the main reason for the hour was just from looking at the behavior of other similar systems, and it was clear that ESD's 8 hours was too long, and DSD's I don't even know what they were, but a lot less. Maybe it was an hour, and that worked a lot better.
Awesome. Austin asks, among the convert functionality, zero fee DEX, the farm, the stock gauge system, etc., which did Publius already have in mind before Beanstalk launched?
Not the convert functionality, not the zero fee DEX, not the farm, not the gauge system. So how about that? This is all a work in progress. This is and this goes to the cool shit you can build on top of Beanstalk is infinite. It really is infinite. But we hope other people are going to come up with some really cool stuff too. And Root is an example of something that other people came up with. That was Mr. Manifold's idea. The farm is something someone else came up with. That was Red Candle Randy's idea. Lots of different ideas from lots of different participants. This is all a soup of incredible thoughts from lots of different people.
Awesome. Uriel asks, thoughts on Mr. Morale and the Big Steppers?
Been bumping it a little bit, and Hendrik's got something to say, which we always respect. We love people with something to say. And then the sound and production is very high quality. So have been enjoying it. But ended up honestly just ended up bumping to Pimp a Butterfly a bunch after hearing it a couple of times. Got me just back on the Kendrick vibe. Not that it's particularly relevant.
Awesome. A question from Wonton. When investors shy away, what are the common issues they have? The current market or Beanstalk's mechanics?
Everyone's got infinite issues, but at the end of the day, people either get it or they don't get it, is what it seems. And the people that don't get it and were kind of, just LARPing in because they miss Terra, if you will. Those people are out. But generally, most of the people we're talking about have Beanstalk-specific conviction.
Awesome. From Disco Stew, any progress on determining which stable we will be able to use to buy in now that the crowd of options seems to be thinning?
I think the DAO proposal included USDC, if I'm not mistaken. So I think that was what was decided. And, the DAO would probably have to vote on anything else being added as far as I know.
One thing I'll add to that Disco Stew is that whatever stable we do support when launching that, you'll be able to swap from ETH into that stable directly from the interface. So that'll help kind of make things easy.
In a single transaction or in two transactions?
In a single transaction.
Hot.
Always gas optimizing here on the farm.
And UX improvement. Come on, who wants to do two transactions?
That's right.
And maybe an approve if you're unlucky.
Yeah, I think the approve is the only one we can't do in the same transaction.
Well, you don't have to, because you've got the point is if you were using USDC, like a new ERC20 token, you'd have to approve it. But if you're using ETH, then you don't have to approve anything. So you could save two transactions.
Awesome. Warthog asks, so Root will offer a fixed interest rate on deposited beans, then invest the beans received into the silo for variable interest. So really a hedge against system volatility.
Yes, exactly. So users can lock in an interest rate, and then the system would take the other side of that. Root protocol, I guess, in that case, would be the system.
Great. Jams asks, what are your thoughts on recent chatter regarding stablecoin regulation?
Well, there's lots of chatter. The short answer is it's very clear after what happened with Terra that the common folk, this is a highly risky thing, and a lot of people don't understand that. And it's very important that there's education for everyone. Now, one of the key pieces of permissionless technology is ultimately that permissionless technology should be impervious to regulation. So other than being aware that there seems to be a high desire to regulate stablecoins in general, the main focus is just to continue to work on a permissionless piece of software that should be from a design perspective resistant to any type of government action of any kind.
Awesome. Kobe Bean asks the interview question, which is 10 years down the line, what do you see yourself doing? Did we lose you? Can you hear us?
You made my brain go flat. I don't know. It's just 10 years is such a long period of time. I'm only 24, so I don't know what I'll be doing in 10 years. God willing, it's related to a positive sum economy built on top of Beanstalk, we hope this is the future, and we want to be a part of it. Just a small part of it at that point, but we hope to be a part of it.
Awesome. Harry Smith asks, any updates on exploited funds? Are there any leads on who copped our money?
All right, so no real leads. This nonsense, but maybe the most substantive lead would be that the lawyers are in touch with the FBI, and the FBI is starting to move here. So hoping to see a little bit of progress on that front, basically. And it does seem like at this point the FBI is starting to treat this as a criminal thing. So that's also cool. Don't know if that's been confirmed yet, but it's that would be the only real progress to report. It's a little bit ambiguous from the government, to be honest. Where it's unclear. They're a little opaque.
I'll add also, Harry, that a couple of chats with security firms that are helping investigate this, and there's been some discussion and reporting, kind of watching some of these addresses that may be involved. So one of those things where when things enter tornado, sometimes it's a bit of a waiting game. So there are people keeping an eye on it. Cool. We'll go to Ultimus. What happens if the funds are recovered after the barn raise?
That'll be a great problem to have, but I've given it no thought. Just don't think it's, don't think it's likely. So, good problem to have though if it happens.
All right, awesome. We've got 2 minutes left. Feel free to raise your hand if you'd like to hop on for one last question. Otherwise, I'll keep an eye on chat. Ultimus asks, are funds sent through Tornado traceable?
Chainalysis seems to have some tools to trace them, yes.
The Black Knight asks, can we expand on which third parties are following up to track the funds?
There's a couple different firms that are working on it. Don't know what's allowed to be public though, honestly. I don't know. That I just don't want to speak out of turn. But that might be something maybe someone can just post an update or something, if that makes sense, sometime in the next day or so on.
Yeah, totally.
Whatever we can comment on.
Yeah, one note on that, Black Knight, in terms of like a reason to kind of lean on the side of undersharing there is that, if certain firms use techniques to track transactions, and this sort of information were to get out and be heard by the attacker, that could be used against us here. So worth keeping that in mind.
It's also just it's not really appropriate to share all this stuff, It's like a private company doing work. Like, here's their secrets. You can't share that.
All right. Well, we're at the hour. Thanks everyone for all the questions. We typically do these on Tuesdays, so I believe the next one will be a week from tomorrow, but we'll keep you posted on that in announcements and stuff. Thanks for attending, and thanks again, Publius, for running through all of these questions.